It's a little bit better today as well. You're about 3-to-1 on the upside, advancers, decliners. That's a change from, frankly, what the last couple of weeks have looked like, where the closes have just been soft. I also like the fact that the leadership today is finally a little bit more risk-seeking. You have industrials continuing to firm. On the other side, utilities on the softer side. So that's important for us. Some of these defensive groups, utilities and staples, have firmed over the last several weeks. We don't think they're leadership, and I would expect if the market's going to resume here, you would expect to see those more defensive corners of the market start to roll.
Sylvia, I mean, very telling intraday chart there from the NASDAQ. Big rally in the last hour or so. For the week as a whole now on the S&P, we're higher by 1% or so. Do you think that the worst is behind us for this little mini pullback we've experienced?
I think we'll probably see some volatility in the near term. I think that'll continue. But, you know, what I think happens is that a lot of investors on the sideline that have been wanting to get in on these names and realize that there's a lot of quality and value in some of the biggest names that have been beaten up, particularly the NASDAQ leaders and big tech names, have probably gotten back in. You know, that coupled with the good news about doubling the amount of vaccines we're going to get, stimulus continuing, and sort of, you know, an acceptance of what's going on with the 10-year, I think is bringing some positive momentum to the NASDAQ.
KBW Banks Index higher, but off the highs of the session after the Fed announced plans to lift its pandemic restrictions on buybacks and dividends by June 30th. Up about 1%, 1.3% or so, but I guess not much ahead of the broader markets. And as we discussed yesterday, unlikely we'll see a massive unleash of buybacks because bank stocks have rallied so much. We might see more of an increase in dividends from here, but it will vary from stock to stock. Some banks still a little cheaper, like Wells Fargo and Citi, than others, like Morgan Stanley and JP Morgan. Sylvia, what's your take as to whether or not this is a nice additional bit of positive news for the banks or something more significant, more game-changing?
I think it's a nice point towards the idea of the reopen and recovery of the U.S. market. So, you know, these regulations went into place to avoid a 2008 and perhaps to avoid some selling of treasuries and sort of mitigate some of that volatility in the market. But I think what we see here is that banks have been resilient in sort of the sharpest and potentially shortest bear market that we've seen. And this tells me that, you know, banks are in a good spot now, right? They're paying you 0% on your savings, but the 10-year going up a little bit allows them to charge, you know, something on loans. So the margin is sort of growing there. And, you know, 0% on savings, maybe you take your money, put it back into the banks and receive some of these higher dividends too. So I do think it's generally positive for the sector.
Well, how did the charts look? They must look positive. The sector's up, what, 16% so far this year, Chris? And if so, any of them look particularly attractive to you? Names?
Yeah, you know, here's what I think is interesting. I want to distinguish between what they've done in the short term and what they've done over the longer term. Because, yes, all the bank stocks are up meaningfully over the last 6 or 7 months here. But a lot of them have made no progress since 2004, 2005, 2006. So we look at these as coming out of these huge bases. They've been in purgatory for 15 years. Look at the long-term charts of the Goldman Sachs, the Bank of Americas, the U.S. banks. These are good-looking pictures longer term. And I recognize that flows are probably too aggressive in the short term. Maybe they pause or consolidate here. You have something like 98% of them above their 200-day right now. So they can pause here, use weakness opportunistically. This is a group coming out of a 15-year range. We like that.
What's your outlook, Chris, on rates? I mean, clearly for some of the retail banks, the shape of the yield curve and the height of it will be relevant. What's your outlook for the yield curve?
You know, well, what's remarkable, and we've talked about this before, if you look at where the street economists are, there are 62 Wall Street economists who submit their yield forecast to Bloomberg every week. There's only 3 of them with a 10-year yield forecast above 2% for year-end 21. That just seems like all the economists still have to move the forecast to the right side. So we're looking for something north of 2. That's been our call. I think in the short term, yield want to pause here. But I think when you're looking out 3, 4, 5, 6 months, something north of 2% is where we're going.
Shepard Smith here. Thanks for watching CNBC on YouTube.